It's hard to say that the March madness is fully behind us, even as a busy month draws to a close, given that the 29th of March was, whichever you prefer, technically Brexit Day. However, I won't go into that here, and I will instead focus on the two major pieces of macroeconomic news flow that are due out in the UK in the coming week, and are really interlinked. The first is the monthly GfK UK consumer confidence reading. In February, this improved marginally to -13, but that was still on a par with December 17 and frankly December 2013. So British consumers don't seem to think things are getting much better, which is something to ponder, maybe with retail and leisure stocks in mind, for example. The second is the latest monthly mortgage approvals data from the Bank of England. The January number came in just below 68,000. Now that's miles below the 2006 peak of 127,000. And, perhaps more pertinently, it represented a year-on-year drop of 0.7%, the 13th such decline in the last 16 months. Now maybe that reflects soggy consumer confidence, but I should point out that a subset of the GfK data, the Major Purchase Index, actually rose to +5 in February. And I'm guessing there's no bigger purchase for anybody than a house, so perhaps that reading offers a little more comfort to mortgage lenders and house builders. Note from the second graphic here how the year-on-year growth in mortgage approvals and the GfK Major Purchase Index seem to correlate, to some degree. Now even if we all know correlation doesn't mean causation, this could be a trend to bear in mind if you take a look at the GfK mortgage approvals data, which we can see here, going back to the launch of Help to Buy in April 2013. Now on the corporate front, with a handful of trading statements, results announcements and general meetings due from FTSE 100 firms, as well as a good range of releases from small and mid-cap stocks to look out for. They include, certain names to note, are utility Pennon, flooring provider and serial dividend raiser James Halstead on Monday the 25th of March, plumbers merchant Ferguson, most of whose business comes from the US, United Utilities, Michelmersh Brick and soft drinks phenomenon Fevertree on the 26th, Rightmove and house builder Bellway on the 27th, so they'll also be looking at that mortgage data, Eddie Stobart Logistics on the 28th, and finally, legacy software specialist Micro Focus and struggling veterinary care provider CVS on Friday the 29th of March. But for me, the company which could really cause the biggest fuss in the week ahead, well, that just might be tobacco giant Imperial Brands. It's due to release a first half trading update on Wednesday the 27th of March. As we can see here, the stock was an awful performer in 2018, but it's rallied hard so far this year. In fact, the tobacco sector currently ranks as the third best performer among the 39 industrial groups which make up the FTSE All-Share Index. Tobacco's got a healthy 19% gain to show for itself this year, and that's been outpaced only by industrial metals, mainly Evraz, and technology hardware. You might think this seems a bit odd given the doom and gloom that hit the sector so hard in 2018, especially as two of the three big issues that weighed on sentiment last year haven't really gone away. Now the first of those, well, that's big tobacco firms are hemmed in by regulation on advertising, brands, packaging, you name it. The result is that global stick volumes are shrinking slowly, especially in the developed West. Secondly, while regulators are already scrutinising next generation products, America's Food and Drug Administration launched a crackdown last year on menthol and flavoured cigarettes and cigars, and they did so to describe what it described as an epidemic of e-cigarette use among teenagers in particular. Also note that market newcomer Juul has been making a big market share splash here. However, the third issue that weighed on tobacco stocks last year, well, that's now looking a little bit less pressing. In 2018, consumer staples firms like tobacco stocks, well, they were dismissed as so-called bond proxies. As the US Federal Reserve raised interest rates and US government bond yields went higher, peaking at around 3.2%, many investors sold yield stocks like Imperial Brands because they could get a decent yield from bonds without taking the capital risk posed by shares. But renewed growth fears and a pause in interest rate hikes around the world may mean that yield stocks are coming back into fashion again. The US 10-year Treasury yield is back to 2.6%, the UK 10-year gilt yield to 1.2%. Now, this is only a trading statement, so Imperial Brand is unlikely to say anything about its dividend, although do note the firm's increased its shareholder distribution every year since its 1996 stock market listing. Chief Executive Alison Brittain did, though, give some pretty clear guidance for this fiscal year alongside last November's full year results. So keep an eye open for any comment on the following points as Imperial seeks to deliver over the long term what it calls modest revenue growth, high margins, strong cash flows. So the first thing to watch, well, for this year Imperial's targeting revenue growth on a constant currency basis towards the upper end of its 1 to 4% target range. The goal is for tobacco to increase and next generation products revenue growth to accelerate. When it comes to operating profit, well, on an adjusted basis this is expected to dip in the first half compared to last year's 1.6 billion. A big reason for that is the additional £100 million investment in the blue next generation product. Do note though, Imperial still expects growth for the full year, and adjusted operating profit came to £3.8 billion last year, as we can see from this graphic. Looking further out, Imperial's targeting medium-term constant currency earnings per share growth of 4 to 8% a year. We can see that trend here, with analysts forecasting growth of 4 to 5% for 2019 and 2020 respectively in the underlying numbers. Please note though that those analyst forecasts do not adjust for currency movements. Thank you for watching, and I look forward to seeing you next time.